Today, we will talk about what is bad debt. Bad debt is an amount of money that a creditor must write off if a borrower defaults on the loans. If a creditor has a bad debt on the books, it becomes uncollectible and is recorded as a charge-off. Bad debt is a contingency that must be accounted for by all businesses that extend credit to customers, as there is always a risk that payment won't be collected. Bad debt is any credit advanced by any lender to a debtor that shows no promise of ever being collected, either partially or in full. Bad debts can occur due to bankruptcy, financial difficulty, or negligence. Businesses must account for bad debt expenses using one of two methods: the direct write-off method or the allowance method. The IRS allows businesses to write off bad debt on Schedule C of Tax Form 1040 if they previously reported it as income. Bad debt may include loans to clients and suppliers, credit sales to customers, and business loan guarantees. Individuals are also able to deduct a bad debt from their taxable income if they previously included the amount in their income or loaned out cash and can prove that they intended to make a loan at the time of the transaction and not a gift. Recording bad debt involves a debit and a credit entry. The allowance for doubtful accounts nets against the total accounts receivable presented on the balance sheet to reflect only the amount estimated to be collectible. Payments received later for bad debts that have already been written off are booked as bad debt recovery. Companies can estimate uncollectible balances using one of two methods: the accounts receivable aging method or the percentage of sales method. The AR aging method groups all outstanding accounts receivable by age, applying specific percentages to each group. The percentage of sales method applies a flat percentage to the total dollar amount of sales for the period. Here are 5 key takeaways. 1. Bad debt refers to loans or outstanding balances owed that are no longer deemed recoverable and must be written off. 2. Incurring bad debt is part of the cost of doing business with customers, as there is always some default risk associated with extending credit. 3. To comply with the matching principle, bad debt expense must be estimated using the allowance method in the same period in which the sale occurs. 4. There are two main ways to estimate an allowance for bad debts: the percentage sales method and the accounts receivable aging method. 5. Bad debts can be written off on both business and individual tax returns. Hope this would help. Thanks for watching.